If you can't explain why a deal is good in under 60 seconds, you don't have a good deal. You have a gamble. Most people are obsessed with price per door, pro forma cap rate, or whatever the broker's flyer says. But none of that tells you if it's actually a good deal. So pay attention. Because the uncomfortable truth is, if you can't look at a deal and quickly answer, why is this a good deal, with real numbers and real risk controls, you're not investing, you're speculating with a mortgage attached. And that's a dangerous thing when you have yours or other people's money invested. My name is Bouchard, and I've acquired many apartment buildings and renovated hundreds of units in one of the toughest markets in North America. Doing so has generated over $25 million in equity for my family and my partners, and I want to help you do the same. And in this video, I'm going to cover 3 lessons about how to know when you actually have a good deal. So look, as a real estate investor, you are looking at deals all of the time. And that's exactly what me and my team do. We review every deal that's out there. And most deals on the surface are information created by someone who's trying to sell the property at the highest price. And that doesn't do any favors or any justice to the people that are trying to buy it. And you've got to be very careful what you're looking at, because what they say the cap rate is, or what they say the expenses are, or what they say the net operating income is usually very, very far detached from what it actually is. And the so-called value add are basically raising rents to a number that only exists in the broker's or the seller's imagination. And even if you do go and do all of the work to get it to the value that they say it's worth, it usually winds up being what you paid for in the first place. So where's the value add? Where's the upside? You have to pay attention to this stuff. And we have to pay attention every single day when we're making decisions before going into a deal. And knowing how to understand that stuff is the key to knowing whether or not you have a good deal. On the flip side, some of the best deals I've ever done looked ugly at first glance. Rough exterior, tired units, but the numbers, the upside and the downside protection were rock solid when you really dug into it. Typical buildings are usually running at a 40 to 50% expense ratio. And that's pretty average. If you're operating with less expenses than that, real expenses, you're doing a fantastic job. And so is the owner, and so is the seller. And if you're operating above that, then that's usually a sign that there is definitely something wrong. And that could be a bad thing, but it could also be exactly where the opportunity lies. And that's usually where you can get in and optimize these buildings to make them run better right off the bat without doing any work to them at all. So how do you actually know when you've got a good deal? Here are 3 simple tests that I use on every apartment building that we do. So first, a good deal pays you today on real numbers, not fantasy, you guys. You have to pay attention to what the numbers actually are, truly. Just ask yourself, what is the actual income being collected right now? And what are the actual operating expenses, including taxes, insurance, maintenance, management, repairs, contingency? All of that stuff matters. And you have to make sure that it's all in there. And if it's not, you have to make an allowance for it. And then after all of that stuff, you plug in today's debt terms, and then you look at what's left. And if the deal doesn't cash flow on conservative numbers before you even touch the upside, it's not a good deal. It's a hope and a prayer, and you're probably putting yourself at unnecessary risk on a deal that you're going to have to put money into every month instead of the deal paying you every single month, which is exactly the point of what we're trying to accomplish here. I want to see positive cash flow with stress-tested assumptions, a debt service coverage ratio that makes sense and isn't razor thin, and returns that make sense before I start fantasizing about all of the rent bumps and all of the perfect renovations that I'm going to do to the building. Because that's your upside, that's your bonus. That stuff should always be secondary. And if the numbers only work in Excel with aggressive rent growth and tiny expenses, that's not a deal, you guys. That's just a spreadsheet fairy tale. And it's just a story you're telling yourself and other people. And it's just not the truth. If you're finding this information relevant to your journey, I'll send you the exact blueprint that I use to create $25 million of equity through my value add strategy. Just comment blueprint below and it's yours. So second, a good deal has a clear, realistic value add story, not just rents are below market value. You should be able to answer this in one breath. What exactly are you going to do to this property? How much will it cost per unit and in total? How long will it take? And what does that realistically do to the income and the value add once you're done? Maybe it's renovating units to a specific standard you've already tested in another building, cleaning up operations and cutting obvious waste and expenses. Those are all typical things. Improving tenant quality and stabilizing collections, or just repositioning the tenant base and amenities so you attract a better crowd. All of those things are tools that you can use to increase the building's revenue, but they're all things that you have to pay attention to no matter what. A good deal has a step-by-step business plan, not just, oh, we'll raise rents a few $100 because the comps say that they should be higher. That's not a real plan. If you can't explain your value add path to a 12-year-old and have it make sense, you don't understand the deal well enough yet. Third thing, a good deal has its downside protected. This is where most people get smoked because they only focus on the upside. And guys, I'm not perfect. I've been guilty of this on my deals before in the past. It's just a natural tendency to want to see the upside, but focusing on protecting the downside is one of the biggest learning curves that I've gone through. And now when I look at things, I look through them from a completely different lens that not only has my optimism built in, but it has a major focus on the downside. I want to know what happens if interest rates go up on the refi. What happens if you don't hit your rent targets as fast as planned, or even at all? What happens if you have a couple of bad months of vacancy or a big repair? What happens if your contractor winds up doubling the cost of the repairs, either through bad management or just no fault of his own? The costs go up. What happens if you have partners that don't pull through and carry their weight in the project the way that they were supposed to? All of these are very real risks that you have to identify and you have to know going in. You have to allow for them, or you're just putting yourself at risk. Is the location strong enough that even if you screw some things up, demand will still be there? Is the debt structured in a way that doesn't blow you up? Fixed versus floating terms, covenants, reserves. Do you have contingency built into your renovation budget? Or are you pretending everything will go perfectly? Again, I've done that before too. And sometimes I've been okay because I've been able to build my way out of it or work my way out of it. But there's been circumstances where I just haven't been able to do that. So don't make the same mistake. A good deal is one where even if things go okay instead of perfect, you don't lose the building and you don't wipe out your investors. The upside should feel exciting, but the downside should feel boring and survivable. And that's for a reason. So now that you know the 3 simple steps and tests that I use to spot a good deal: real cash flow today, a clear and realistic value add story, and protected downside, you can stop guessing based on brochures and start evaluating deals like a pro. If you found this video helpful, you already know that the best way to support my journey is to like, share, and follow along. And if you want to know more and learn how to get involved, click the link below and find out how you can live the ultimate real estate lifestyle. Love you guys. See you on the next video.